you could see how fast everyone took what the terminal rate's going to look like. I had a conversation with the ultra smart credit guy at dinner last week, and he was thinking the terminal rate was going to be somewhere between 6.5% and 7% potentially. Mm. And now Goldman came out and said, 5 to 5.5.
All right. Okay. All right. After a little technical difficulty, we're back, right? Okay. But so we ended on some like kind of negligence, right, or perhaps like gross issues with kind of the risk team there, right? But look, I would say this. I think everybody's well read on what just happened. It's not good. 3 banks go down, the whole thing. I'm interested. Like, what's going to come next, right? So it looks like, based on like to what Nick said, it looks like what this thing that the Fed did over the weekend, the FDIC did over the weekend, it doesn't look like there's going to be a whole bunch of more bank failures here, right? Like there may be 1 or 2 are dropped, but like First Republic was going to go. It looks like it's coming back. There was some like stuff around Schwab that looks like it's doing okay now. I saw one analysis out there with other firms that have big securities portfolios, right? But I'm not seeing any kind of major movements in their stock price, right? And I'm not hearing anything about running a bank. So does everyone kind of agree that maybe we're cool here? Like this fixed the problem? Like we're not going to have a whole bunch of more runs on banks in the future?
I think these things bottomed. I mean, I think there's a lot of diversity now across board. People have figured it out over the past few days. I think the bigger question at hand, I think 2 things. One, how much more expensive did cost of capital become for early stage founders on the back of this? And then 2, what does the Fed do? I mean, I think I sent you guys a note, like Goldman took down their rate expectations. You had a cooler CPI today. Like, I don't know, silver and gold are exploding, rate sensitive, high growth software is exploding. Facebook cut jobs, that stock's up massively. Like, I think the bigger question is, did the equity markets bottom?
Yeah, I don't think the broader equity markets are going to bottom, but I think the attack on the banks, I mean, First Republic's up at time of recording 35% right now, right? So maybe the onslaught there has definitely slowed down, but I think we still have the broad market issues, right? I mean, we're definitely seeing that in the private markets, not just when you get the news that the big companies are laying off 10,000 people in one go. Aaron, maybe it's worth pulling up that slide of showing the correlation to what we see in the secondary markets versus the Silicon Valley Bank share price over time. So
I'm calling the lows, by the way, here. I hate
the low of the broader market, the SPY.
I think it's time to get long, fellas.
Yeah, grabbing those ETFs.
I hate to do it.
Okay, I mean, just interesting, just to describe what's on page. You've got the IPO 50, the broad representation of the 50 most active pre-IPO stocks, which also is a decent overlap with some of the loans that Silicon Valley Bank would have been putting out. But you have a 0.71 correlation over the last 2 and a bit years, went all the way up to 0.91 over the last year, so 2022 to date. And then it just dropped and fell apart this year to date, to 0.15. So you're really just seeing some good correlation here. And I think that's what's hurt them. You're not going to see the same degree of correlation with a lot of other banks. They're just married at the hip to the Bay Area, and a lot of these growth or venture names. So I think, Aaron, you pointed out, I think it was 3% startups for the loan book, 6% growth stage, and another 12% innovation stage. And then not to mention what they didn't hedge on the long duration bonds, like their agencies and things like that. But yeah, I think it tells a pretty decent picture.
So Don, talk more about your thought on the impact of venture startups, right? Like, what do you think now that SVB's gone? Do you think someone kind of fills the gap, what the services that SVB was providing?
I mean, there's going to be the usual suspects. Like WTI has been doing this a very long time, and they're very successful at it, right? And SVB was, super competitive with them. But I mean, how do you how do you step in as a bank and take this risk and go to your shareholders and say, oh, guess what? We're taking over all the venture debt loan book from Silicon Valley. Like, no one's really going to want to touch this. Yeah, you look at what happened with Signature too. I mean, we haven't really discussed that, but talk about the crypto ecosystem. Like, everyone that's a crypto fund or company is scrambling right now to find a banking partner. You lost Silvergate, you lost Signature. You know, BMO Harris has stepped in, but, you know, that process, it seems from what I'm being told, is pretty daunting. And, you know, with the insurance amount, they're not really insuring much above the limit. And it's hard. I mean, that ecosystem is going to be very difficult for a lot of people to find a banking partner for. If you're a venture-backed company, it's easy to find a banking partner. You call JP Morgan or BAML, you know, they'll be happy to set you up. But yeah, as far as, you know, who's going to give these folks money now, I mean, at that rate, like, good luck.
Yeah, this is very different than the financial crisis with regards to, like, TARP, the Toxic Asset Relief Program. You can't just model these out the same way as a pool of mortgages, right? They're all unique. They're all very different situations. So I think, yeah, a lot of the losers here are going to be the direct clients of SVB. I mean, where are they going to end up, or who's going to take on the other side of that those loans? Yeah, and generally, just raising capital now is going to be harder on the equity side too. So you're kind of getting hit on both ends from your Series
talk
A,
more
B,
about
C,
that.
D.
Yeah, so
companies.
talk more about that, on how it impacts, on how this you think impacts the equity side. That's the first time I've heard someone say that.
Yeah, I think it's going to go both ways. So let's say we're going back to the equity market for our next round, and we already know that those markets are down and they're getting hurt. So you have a combination of debt and equity for a lot of companies that are accessing capital. But now now that we know the equity side is getting hurt, and a lot of folks don't want to take those down rounds, going to the debt market just got a hell of a lot harder, because now, instead of maybe getting some favorable treatment with firms like SVB that really wanted to work with you and hold your hand and understand your process, you're going to have to go to the net benefactors here. So your Citis, your JP Morgan Chase, your Bank of America, I think. So
I don't even think they'll do it, though. I think it's going to be more or less a lot of these credit guys that are going to move down. But, like, guess what? Your rating ain't going to be 5%, or it's going to be SOFR plus 900.
Yeah, that's not a partner.
This is where we're willing to underwrite this risk, right? So
those guys aren't partners, right, Don? Those guys are they're like
making money.
They're lenders. They're in there for the return, not like, we'll be a great partner and hang with you till you IPO, and we'll do loans.
No, there's going to be crazy covenants on it and all this other stuff.
Right. And that's why I think the TARP outlook, where government could help out, that's not going to happen properly either. So, Don, if you are bringing one of your portcos to the next round, where are you looking? Are you looking for debt? Are you looking for equity?
I mean, it
capital
depends
raise?
at what stage the company's in and what their balance sheet looks like, and if they have, AR, accounts receivables, a consumer facing, right? There's like a ton of, what are they doing in ARR? How do you back this? Like, there's options out there, and you see some of the more sophisticated folks like, Ares and, big credit funds like Brigade and whatnot. Like, they're doing growth deals and doing credit. The problem is, if you're a founder and you're raising at a $12 million valuation, like, you're not getting that non-dilutive, equity debt deal from Silicon because they want your deposits for the next 10 years.
Right.
Yeah,
right.
That's the challenge. I don't think the growth stage companies are going to have problems. If you're doing $100 million in revenue, and your EBITDA break even, like, you're not going to have an issue getting money.
That is true. So like, that's really just the earlier stage companies is where there's kind of a problem. But
are more venture funds going to step up with the product to do that? I mean,
but Don, I got to tell you, man, I talked to a lot of venture capitalists. They actually hate venture debt. They hate it, right? Especially for earlier stage companies, right? So, like, do you think that just starts to reverb a little bit across the broader venture space? Like, look, save the venture debt for Series C, D, E companies, later businesses. If you're earlier stage, stay away from this stuff altogether.
Yeah, I mean, I think VCs hate it because, it took the bat out of their hand on probably a lot of deals and ownership where, now you could go in and negotiate better terms for yourself, your LPs. Maybe these things were mispriced because, founders knew they could go and get venture debt, but, it's going to be interesting. I mean, I think, you're really going to see this shake out over the next 4 to 6 months. It's all very fresh.
Shake out of what?
You just called the bottom. So what
I mean, shake out
yeah.
in venture land of how companies are funding, are they changing the dynamics of rounds, pricing coming down? How does that going to look? But
so that's an interesting point, because I got to tell you, you're not the first person that I talked to this week who's risk on now, right? And I had some folks who were very conservative.
I mean, this market's all
Definitely risk
Fed driven. What we've seen, it's going to be really interesting. You could see how fast everyone took what the terminal rate's going to look like. I had a conversation with the ultra smart credit guy at dinner last week, and he was thinking the terminal rate was going to be somewhere between 6.5% and 7% potentially. Mm-hmm. And now Goldman came out and said, 5 to 5.5. And everyone took it down from 25 bips rates to 14 bips to J Powell's going to ease. So
Right. Okay. So, but that kind of begs the question, now that I'm hearing that kind of percolate out there, that things are going to start to get a little bit better in the broader equity market. How does that impact, pre-IPO stocks, private stock, tech, high growth companies? Are they going to lead? Are they going to lag? Is venture funding going to pick back up? If everything's kind of gaga, right, in the public markets and everyone's feeling good and the economy's good, this thing come back faster or slower?
I mean, if you're a smart investor, you're probably going to suffer PTSD from this for a while. And I don't think all of a sudden, you're not going to see software multiples go from 8 times to 25 times what we saw, in the peak of 21 market. That ain't happening. Mm-hmm. But does it open a capital markets window where there's risk on and people are willing to take shots on companies at a specific price? Sure.
Yeah. Yep. Okay, got it.
I used to gauge how the market would trade for the week by how many biotech IPOs there were on a Monday morning announced. Because that's thick, and it worked every time. I could tell you where the market would close on Friday if there was 12 biotech IPOs on a Monday morning.
That's interesting. Interesting.
Are we going back to that time? No.
Right.
So.
But it's not. Listen, it could be a turning point. I mean, it'd be interesting to see what Powell does. There was on Monday, everyone was this is it. There's no more rate increases. Then on Tuesday, yesterday afternoon, this morning, it was he's going to do 25 basis points. The Fed futures have it at 25 bips. They even have a high probability that he does another 25 at the next meeting, right? The Fed does another 25. So that would only be, if all of these shenanigans, it would only be 25 basis point less than the terminal rate that they were highlighting, for a year now, right? Or better part of 6 months. So,
all you got to do is watch the VIX. Friday, the VIX priced in kind of Monday morning action, and then volatility didn't get sucked out. They'll post the CPI this morning, and now the VIX is down 11%.
Yeah.
So.
Yeah. So Nick, what are you hearing out there, man, from just pre-IPO land with your broker partners, your clients? Is there any kind of what's the feel on all this SVB and bank issues?
So we had a rather quiet week. We actually had a lot less price. Coming in, we got our levels on Monday, and a lot less came through. So I think people are kind of holding their breath as to where they're willing to buy and sell and take action.
Okay.
And I think by the end of this week that will shake out, and we're going to see more deals get done. But I think you kind of had everybody take a breath and step back, and that's why we saw that on our end. And my personal opinion on the back of that is also you're going to see a lot more cherry picking. So a lot more thought is going to go into, hey, do I want to not just be in these late stage companies, but which ones I'm going to be very, very thoughtful about, rather than just exposing dry powder into the sector as a whole.
Okay, so Clint texted in. So Clint's having some technical issues. I don't know if it's him or the software that we're using, but at any rate, he texted in. He said, banks. So, and I've heard him say this earlier, or maybe over the weekend, but he's like, regional banks are going to have an issue. Like commercial real estate's coming next, right? That's his thesis. And with the rate, now that the Fed has raised these highs, like things are starting to break, right? So this SVB thing was an example of something breaking. The next thing to break is commercial real estate. I think PIMCO had a building that went belly up, right? But there's probably others that are coming too, right?
That you've seen, one of my good friends is a very large commercial real estate book, and I looked at a deal with him, and the amount of leverage that's in the system there for people that own multifamily, like New York City, even like there was a building for sale in Soho. The guy had a crazy ask on it. He was asking like 75. It was probably worth 40, and he was levered to the gills. Like, smart guys who are sitting on capital that aren't over levered, like, yeah, I'll give you $100,000 for the keys and I'll take over your debt. Like,
right.
How much of that is going on? I think a lot right now.
Yeah, this commercial real estate thing is going to get really interesting. I mean, we're the three of us here in New York City, right? So there's definitely not everyone's back to work, and I can certainly see the revenue side of the equation for a lot of these buildings being upside down, right? And then now with rates coming up, going up, they're going to get even more margin pressure, right? So,
and they implement the congestion tax also. Get ready.
Yeah, so
$23 each way.
Yeah, which is nuts.
Crazy.
Which is nuts. So that kind of begs the question: like, what's the thought? Are we going to see more of these? Are we going to see more, bank failures now? Like now that these rates keep going up, are they cycling through? Is this commercial real estate going to put more undue stress, or not undue stress, but more stress on banks?
I don't know. It's tricky. I think those are pretty well hedged out, and the guys underwriting those deals are much smarter than just putting venture debt into a company that they're like, okay, this person priced it at $8 million, so that's what you're worth.
Right.
Yeah.
Or at least they're smart enough to hedge out their available for sale and help for maturity securities portfolio.
Yeah.
Right.
Yeah. And I think the quality behind those is better following the financial crisis. A lot more sanity checks, and the willing buyers of CMBS are picking it up, right? So the risk is spread pretty well, not just from the banks, but to the asset managers, the holders of the pooled mortgages, right? So I think lessons are largely learned. It's going to stay hard no matter what. But yeah, I think New York almost might be a more interesting base case, right?
So I'm sensing like this general sense of positivity, right? From the YouTube. I kind of feel that way based on what I'm hearing. Like this seems like it feels like it's a material event, right? That just occurred. And now, inflation was already coming down. Like it feels like it's positive, but I'm getting positive vibes from Don. I'm getting positive vibes from Nick, right? I mean, is that the general consensus here? Is that could be a turning point type event?
Yeah, do you think J Powell's just going to keep pressuring, ratcheting rates over and over again after we have events like this and we have warning signs of commercial real estate? Probably not. I think, they have to have a balanced approach here, and they have a profound impact on the direction of this market, particularly on the CMBS side, more so than anything that we see on the private equity side, right?
Right.
So,
right.
Well, the question
I think
too
it's going to be under control.
The question around inflation too, like the Fed's inflation target is like idiotic. Like that's just anyone with half a brain knows it's not achievable. So let's take that out. Like a quart of ammonia in 2020 cost $2. It's $4.25 on sale now. So is that inflation or is that price fixing? Because I know a lot of people that took up prices, and guess what? Those companies ain't taking down prices anymore. So
right.
It's the new norm.
Yeah, that's a fair point. It's just
you have commodity costs. I mean, that's what's going to drive this in one way or the other, right?
Yeah.
Well, but also sorry, go ahead, Aaron.
Yeah, I mean, but also too, some of the structural ways that inflation is calculated, right, with housing and the like. That's rolling. That's going to start rolling off here in the next couple quarters as well.
Yeah.
So, yeah, I mean, But that's the thing that seems to be the focus of the Fed. But to Nick's point, it sounds like the Fed, Don, you said it earlier too, the Fed's the driver here, right? So as soon as the market feels like they're going to stop or they're easing off, then that's when things.
Well, think
have a
about
chance to get
too
better.
the amount of inflows that you're going to get into the cap or the equity markets once they pause.
Oh, there's a mountain of cash. Everybody I'm talking to, every single investor that I talk to, is a mountain of cash. Every week, every month, it just keeps getting bigger. So, I'm not like a technician, right? But man, it feels like once this is risk on and like everybody knows it, it's a tidal wave of money.
I got a bunch of charts to share next week if you guys want to go through a public market symposium.
I'm down, man. I'm down. But okay, listen. I think we're like at time now here, boys. Any other thoughts on banking, the Fed, SVB?
You got to have something for next week, right?
Best practices for hedging a held for maturity securities portfolio. How about just do it? How about that, right? Just hedge, right?
Yeah.
All right, cool. All right, gentlemen. Well, I appreciate you. I'm sure Clint apologized. I don't even think it's his fault. I think it's the software that we're using. But I apologize to Clint for getting bounced. But Nick, I'll see you tonight, right?
You got it.
All right, brother. Okay, thanks, gentlemen.
Don, make it
Appreciate
happen,
you.
dude.
I'll try.
Come on, Donnie.
All right. Later, guys.
See you guys.